Preparing for a sovereign wealth fund investing at ADIA interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at ADIA? I'm drawn to ADIA because it combines global scale, a patient sovereign mandate, and investment discipline across public and private markets. Unlike a short-term fund, ADI can think through cycles and allocate capital where risk-adjusted returns are strongest. I also like the institutional style, rigorous research, debate, and humility around uncertainty. For me, the fit is using analytical work to support decisions that protect and grow long-term national wealth. While answering, focus on ADIA's sovereign mandate, long-term horizon, global diversification, disciplined research culture, and why your skills fit institutional investing rather than short-term trading or purely transactional roles. Question 2. How does a sovereign wealth fund differ from a hedge fund, pension fund, or private equity fund? A sovereign wealth fund invests national financial reserves, usually with a very long-term mandate. That changes the opportunity set. It can accept illiquidity in private equity, infrastructure, and real estate, if compensated properly. A hedge fund may focus on shorter-term alpha, while a pension must match liabilities. ADIA's edge is patience, scale, diversification, and governance. The key is not simply chasing returns, but earning durable risk-adjusted returns across cycles. Make sure to cover mandate, funding source, time horizon, liquidity needs, transparency constraints, and return objectives. Contrast ADIA with pensions, endowments, hedge funds, and private equity without overgeneralizing. Question 3. Explain the difference between strategic asset allocation and tactical asset allocation. Strategic asset allocation is a long-term, buy-and-hold approach. It involves setting a baseline mix of asset classes, such as stocks, bonds, and cash, based on an investor's long-term goals and risk tolerance. This mix is reviewed periodically, but changes are generally infrequent. Tactical asset allocation is more flexible and short-term. It involves making tactical shifts in the asset mix to take advantage of short-term market conditions or to capture opportunities. This approach requires frequent adjustments based on market trends and economic changes. In short, strategic allocation follows a long-term plan, while tactical allocation adjusts actively to achieve short-term gains. Strategic asset allocation is the long-term policy mix across equities, fixed income, alternatives, real assets, and cash. It reflects return targets, risk tolerance, liquidity, and the fund's mission. Tactical allocation is the shorter-term tilt around that policy, based on valuations, macro conditions, or dislocations. At ADIA, I would expect the strategic framework to dominate, because consistency matters for a sovereign investor, while tactical views should be disciplined, sized carefully, and measured against risk budgets. In your answer, talk about policy portfolios, long-term expected returns, risk budgets, rebalancing, short-term market views, and why a sovereign investor like ADIA would emphasize discipline over market timing. Question 4. Walk me through how you would evaluate a new investment opportunity for ADIA. I would start with the investment thesis, what drives cash flow, valuation, and downside protection. Then I would test market size, competitive position, management quality, capital structure, and exit paths. For a public equity, I would compare intrinsic value with market price. For private assets, I would stress entry multiple, leverage, and operational improvement. I would also ask whether the opportunity improves total portfolio diversification, because ADIA evaluates investments within a broader sovereign portfolio, not in isolation. Be sure to mention investment thesis, expected return, downside protection, valuation, risk factors, liquidity, diversification benefit, governance process, and how the opportunity fits the total portfolio rather than standing alone. Question 5. What is your current macro view, and how would it affect a long-term investor like ADIA? My current view would separate cyclical noise from structural themes. Inflation has moderated in many markets, but rates may stay higher than the last decade, if fiscal deficits, geopolitics, and supply constraints persist. That affects discount rates, equity multiples, real estate cap rates, and private market exits. For ADIA, the implication is not making a one-way macro bet, but ensuring the portfolio is resilient across inflation, recession, and policy surprise scenarios. While answering, focus on inflation, interest rates, growth, geopolitics, currency effects, asset valuations, and portfolio implications. Avoid sounding like a short-term forecaster. Emphasize scenarios and resilience. Question 6. How would you assess an external investment manager? For an external manager, performance is only the starting point. I would assess whether returns are repeatable, risk-adjusted, and explained by a clear investment process. Then I would review team stability, capacity, alignment through co-investment or fees, operational controls, and drawdown behavior. A manager with excellent recent returns but style drift or weak risk systems would concern me. ADIA needs partners who can compound capital responsibly over many years, not just one cycle. Make sure to cover performance attribution, process repeatability, team stability, capacity, fees, alignment, operational due diligence, risk controls, style drift, and whether the manager adds value after costs. Question 7. What would you look for in a private equity co-investment opportunity? In a co-investment, the attraction is lower fees and greater control over exposure, but the diligence burden is higher. I would examine why the sponsor is offering the deal, whether incentives are aligned, and whether ADIA has enough independent conviction. Key work streams include company quality, leverage sustainability, entry valuation, downside case, and exit assumptions. I would avoid simply following a brand name sponsor. The co-investment must stand on its own risk-return merits for the portfolio. In your answer, discuss sponsor quality, reason for syndication, independent diligence, valuation, leverage, operating plan, downside case, exit route, fee advantage, and alignment with ADIA's existing exposures. Question 8. Why are infrastructure assets attractive to a sovereign wealth fund? Infrastructure suits a long-horizon investor because many assets generate contracted or regulated cash flows over decades. I would focus on demand risk, concession terms, inflation linkage, counterparty quality, regulatory stability, and maintenance capex. The valuation should reflect both yield and growth, not just headline EBITDA. For ADAI, infrastructure can provide diversification versus listed equities and bonds, but the team must be careful about political risk, leverage, and overpaying for safe assets. Be sure to mention long-duration cash flows, inflation linkage, regulatory risk, leverage, demand risk, concession structures, diversification, valuation discipline, and why infrastructure is not automatically low risk. Question 9. How should ADIA think about risk management across a global multi-asset portfolio? Risk at ADIA is broader than daily volatility. It includes market risk, credit risk, liquidity risk, currency exposure, concentration, leverage, operational risk, and reputational risk. I would use quantitative tools like VAR, stress tests, factor analysis, and scenario modeling, but I would not rely on them blindly. The judgment piece is asking what happens when correlations rise, liquidity disappears, or assumptions break. A sovereign portfolio needs resilience in both modeled and unmodeled environments. While answering, focus on market, credit, liquidity, currency, concentration, leverage, operational, and reputational risks. Include stress testing, factor analysis, scenario planning, and limits of quantitative models. Question 10. How would you approach liquidity planning for a portfolio with significant private market exposure? Liquidity planning matters because illiquid assets can look attractive until capital calls, distributions, and market stress collide. I would forecast commitments, unfunded obligations, expected distributions, operating cash needs, and downside liquidity scenarios. For a sovereign fund, the issue is not meeting redemptions like a mutual fund, but maintaining flexibility to rebalance, fund commitments, and buy distressed opportunities. Good liquidity management prevents forced selling and lets patient capital be truly patient. Make sure to cover capital calls, unfunded commitments, distributions, stress liquidity, rebalancing capacity, cash drag, secondary sales, and the danger of being forced to sell during market dislocations. Question 11. Walk me through how you would value a listed company for a long-term public equities mandate. I would triangulate valuation rather than rely on one metric. First, I would build a DCF around revenue growth, margins, reinvestment, working capital, tax, and cost of capital. Then I would compare trading and transaction multiples with peers, adjusting for growth, returns on capital, leverage, and accounting differences. Finally, I would run scenarios to see what the market is pricing in. For ADIA, the key is not a precise target price. It is margin of safety and long-term compounding potential. In your answer, talk about DCF, comparable companies, accounting adjustments, return on invested capital, balance sheet quality, scenario analysis, margin of safety, and long-term compounding rather than short-term price targets. Question 12. Tell me about a time you disagreed with an investment view. How would you handle that at ADIA? I would separate facts from interpretation. If a portfolio manager disagreed with my view, I would ask which assumption drives the difference: growth, margins, discount rate, exit multiple, or risk assessment. Then I would bring evidence, sensitivities, and base upside and downside cases. The goal is not to win the argument, it is to improve the decision. In an institution like ADIA, intellectual honesty and respectful challenge are essential. Be sure to emphasize evidence-based disagreement, humility, separating assumptions from conclusions, sensitivity analysis, respectful challenge, and ADI's likely preference for collaborative institutional decision-making over ego-driven debate. Question 13. Describe an analytical mistake you made and what you learned from it. In one project, I initially focused too much on the base case return and not enough on downside liquidity. A senior colleague challenged me, and I rebuilt the analysis around stress scenarios and funding needs. The recommendation changed. The opportunity was attractive, but position size needed to be smaller. The lesson was that good investing is not just identifying upside. It is surviving adverse paths without damaging the broader portfolio. While answering, choose a real but controlled example. Focus on ownership, correction, improved process, stronger review habits, risk awareness, and what changed in your investment or finance analysis afterward. Question 14. How should responsible investing or ESG considerations be integrated into investment decisions? I see responsible investing as part of risk assessment, not a separate marketing exercise. Climate exposure, governance quality, labor practices, and regulatory risk can affect cash flows, cost of capital, and exit values. For ADIA, the right approach is disciplined integration. Evaluate financially material ESG factors, engage where ownership allows, and avoid simplistic exclusions unless policy requires them. The objective remains long-term risk-adjusted return, with sustainability considered because it affects durability. Make sure to discuss financially material ESG risks, climate exposure, governance quality, regulation, engagement, exclusions where appropriate, fiduciary duty, and the link between sustainability and long-term asset durability. Question 15. If global equities fell 25%, how would you think about rebalancing the portfolio? I would not automatically de-risk after the drawdown because that can crystallize losses and reduce long-term returns. I would first diagnose the cause: earnings shock, REIT shock, liquidity event, or structural impairment. Then I would compare actual weights with policy targets, review liquidity, and stress test further downside. If fundamentals remain intact, rebalancing into cheaper assets may be appropriate. If risk capacity changed, the response should be measured, evidence-based, and governance-approved. In your answer, cover cause of the drawdown, policy weights, risk capacity, liquidity, valuation, fundamentals, governance, behavioral discipline, and the difference between rebalancing and blindly buying the dip. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.